financial statements have been prepared, we need to get our books ready for the next accounting period. The next accounting period, we need all our revenue accounts and all our expense accounts and our dividend accounts to all be zero. To do this, we need to book journal entries called closing entries. Again, the revenue accounts, the expense accounts, and the dividends accounts are all considered temporary. They track the balances just for one accounting period. And at the end of the accounting period, they need to be closed out, or their balances need to be brought to zero. Balance sheet accounts, such as cash or inventory, of course, they don't get closed out. Their ending balances carry forward from one period to the next. Just like the amount of cash that you have in your wallet the night before is the same amount that you wake up with the next day. That differs from revenue. Think about revenue, it must be for a period of time. And when that next period of time begins, let's say the next quarter or the next month, the revenues start at zero and new revenues need to be earned. True or false? Revenue accounts carry a normal credit balance. Well, we should know that by now, that is true. Revenue accounts carry a normal credit balance, or to increase revenue, we book a credit to revenue. So in order to transfer the balance in our revenue accounts, we have to book debits to each revenue account. Here's what the journal entry looks like. Now, if we had more than one revenue account, we would have more than one debit. Maybe if the company has sales revenue, service revenue, and rent revenue, you would book 3 separate debits to clear out or bring those account balances to zero. And the other side would be for the total is to an account called income summary. Now you may be thinking, in the last slide, we said we transfer all income statement account balances to retained earnings. So how come our credit here, which looks like we're transferring out of revenue accounts and into income summary? We do transfer into income summary. Then the next step is to transfer all expense accounts into income summary. Then we take the total balance in income summary, which of course should equal our net income, and transfer that as our final step into retained earnings. True or false? Expense accounts carry a normal credit balance. Of course, that's false. Expense accounts carry a debit balance. So at the end of the period, we want to show zero in every one of our expense accounts to start for the new period, the new accounting period. What do we need to record? We need to record credits for the total amounts in each expense account. So we see here credits to each expense account, and the total is debited to income summary. So now we have a balance in income summary. This example that we just showed, there was one credit booked to income summary. That's where we shifted revenue into the income summary account. And here we're shifting all of the total expenses into income summary. So income summary will have one net balance. We need to transfer that balance from income summary into retained earnings. So when we credit retained earnings, are we increasing retained earnings or decreasing? Remember, if we credit an equity account, we are increasing it. And that's exactly what we want to do. Remember, what is retained earnings? Last period's retained earnings, or the beginning balance, plus net income. With this entry, we just added the net income into retained earnings for the new accounting period. But remember, that's not the only thing that affects retained earnings. It's not only net income. True or false? The dividends account carries a normal credit balance. We need to know which type of balance it is in order to clear it out. False, of course, the dividends account carries a normal debit balance. Remember, D for dividends and D for debit. So in order to close out or bring its balance to zero for the dividends account, we need to credit the dividends account to get its balance to zero. We don't worry about the income summary account here. We go directly, the other side of the entry will always be a debit or a reduction to retained earnings. Once all of the closing entries are recorded, every revenue account, every expense account, and the dividends account will all have zero balances. And that's exactly what we want. That is the official end of the accounting period and hence closing the books. Because now we're prepared the next day when the new accounting period begins and new transactions take place. They are reporting the revenues, expenses, and dividends only for that new accounting period. In the next video, we'll walk through an example.